Everybody, welcome. Today we're going to be talking about probably it's my second favorite loan, but it's the loan that I've one of the first loans that I used a lot early in my career and really learned how to do. So today we're going to talk all about FHA loans. We're going to dive in deep. We're going to do a complete A to Z, all the ins and outs of the FHA loan programs and what's good about it, the pros and cons, and all of that stuff that we'll go into. So my goal here is to do about once a month. I'm going to be making a video series that's this one video a month on that particular type of loan program. Obviously, we're going to be releasing other videos that we have in there as well, on different types of things, but I really want to dive deep into different types of loan programs so that you guys out there can really understand them and understand why a particular loan program is better than another one. So let's get right into it. So today we're going to talk all about FHA loans. And here's kind of just a quick little bullet point of what we'll be covering today. Who are they for? What are the ins and outs of FHA loans? How do the credit score requirements work? What are the minimum credit scores that you need on an FHA loan? What are the documentation requirements for FHA loans? And how do appraisal requirements factor in on FHA loans? What are the standards that FHA wants for their FHA appraisals on the property? And then we'll also go over, the different pros and cons of FHA loans as well with that. So let's just do a quick little look at FHA loans and kind of a general idea of them. So FHA loans have a lower down payment. They're more accessible for home ownership with a minimum down payment of just 3.5% of the purchase price. And believe it or not, FHA loans are one of the most successful loan programs, government implemented loan programs to ever exist. It came about in the early to mid 1930s, and they basically needed a loan program to allow more people to become homeowners. At that time in the 1930s, there's a very small percentage of people that were actually homeowners. So the government needed to come up with a program to help increase the level of home ownership in that. FHA's got easier credit requirements. They've got a lot more forgiving credit criteria for potential home buyers with lower credit scores. And then also FHAs do have mortgage insurance. They have a mandatory monthly mortgage insurance premium, also called MIP, that's both upfront and monthly, that increase the overall loan cost. And we'll cover that a little bit more later as we go into it as well. FHA loans have really flexible debt to income ratios. They allow for a higher debt to income ratio, but specific limits are going to vary by lender. So be aware of those requirements, and we'll discuss that more as well. And then also there's property standards. Homes must meet safety and livability criteria requiring a home inspection. We're going to go into that a little bit deeper as well. And then there's also loan limits. FHA has different loan limits that are set per county and per state as well. And another thing that we'll talk about, this is actually getting really popular right now at the time of this video in August of 2023. And I get this question probably once or twice a week, about assumability of loans. So a buyer can take over an existing FHA loan when you sell your home if it has a nice low interest rate on it. We're going to go into that a little bit deeper as well too, because there are some various caveats on that we have to look into. Streamline refinancing. This is really a neat feature about FHA loans. We can actually refinance a current FHA mortgage when rates do go back down into a lower FHA mortgage without having to do a full documentation file or getting a home appraisal on the property as well. And then availability. Most lenders, banks, mortgage companies, brokers, they're going to offer FHA loan programs. The majority of lenders do. And remember, while FHA loans, they do offer benefits for home buyers, it's really careful to evaluate your financial situation. Everyone's different. That's why we always like to show a few different comparisons. Hey, here's what an FHA loan looks like as opposed to a conventional loan, and why it's important to do that. And here's some notable recent changes that we've seen recently. So with the market changes, FHA loans are a lot more acceptable now. There's new loan limits as home prices have increased, as they've continued to do in the past few years, we've also seen those loan limits increase. Private flood insurance is now accepted, which is a lot cheaper. Just a few years ago, there was a mandatory flood insurance that if that property was in a flood zone and you were getting an FHA loan, you had to get that particular flood insurance. FHA is now allowing for private flood insurance from a private insurance company to be able to do that. And it makes it a lot more affordable. And they're also now accepting rental history as well as something we can use to help do that with FHA qualifying. So real quick, what is FHA? So like I was talking about earlier, FHA was created in 1934 due to the need for more housing and homeownership. America was mostly a nation of renters, like literally 10% of the population in the United States in the 1930s was homeowners. Only 1 out of 10 people owned a home. And it's under the Department of Housing and Urban, or called HUD for short, development. And this is something important to note. FHA does not make loans. They only insure the loan. So if you ever hear arguments of, well, FHA says we'll do this, it doesn't necessarily mean that that particular lender might do that. So that's something to pay attention to as well. And like I mentioned earlier, it's also one of the most successful programs that have ever been implemented by the federal government in the history of the United States. It's just a very great program. It's had very little changes, and it's really allowed home ownership to increase significantly over the years in the United States. So what are some of the pros of FHA mortgages? Well, they're a lot easier to qualify for than conventional counterparts or conventional mortgage counterparts. They typically have lower interest rates, and they also have lower down payments, only 3.5% down. They also allow for a higher debt to income ratio. As a matter of fact, you can go as high as a high 56% debt to income ratio with what's called an approved eligible automated underwrite. They also have very flexible rehab options that we can do. And there's some good opportunity for investment options that we're going to go into a little bit later. I'm going to talk about house hacking a little bit. And FHA loans are also very forgiving of past credit hiccups. They're more concerned with someone's last 12 to 24 months of credit history and payment history. They're not going to beat someone up so much for something that might have happened 3 or 4 years ago. And then they also allow for higher seller concessions. They will actually allow for 6% of the sales price of the home to be used as seller credits that can be used to help buy down the interest rate, cover closing costs, etc. But it has to be used for closing costs. That's something important to note. And then let's go over some of the cons. FHA loans, they have mandatory mortgage insurance. So if you're in an FHA loan and you've put the minimum 3.5% down, you're going to have mortgage insurance on that loan forever until we refinance out of it or you sell that house with the FHA mortgage. So that's something to keep in mind as well. And we're going to go over that a little bit as well. And then lower loan limits allowed per county. They do have some more strict appraisal requirements. We're going to get into that as well. And sometimes it's not as favorable to sellers. It requires a good lender and a good realtor duo to really be able to explain that to the selling side, the listing agent that represents the seller, and the seller on why that particular loan makes sense. And again, it's got lifetime mortgage insurance. You must refinance eventually out of that FHA loan in order to get rid of that mortgage insurance. So real quick about me, my name's DeHart. I've been a mortgage loan advisor since March of 2003. So at the time of this video, in August of 2023, I'm coming up on about 20 and a half years. And in that time, I've been very blessed to be able to help about 3,300 families now either purchase a home or help develop an investment portfolio, buy some second homes, and or save money with strategic refinances by doing debt consolidation and things like that. So very honored to be able to be doing this for as long as I have. And I'm also an accredited instructor for government loans. So FHA and VA loans, I actually teach to the real estate community for continuing education. And I also like to really focus on wealth building for our clients and their families and teaching them how to understand credit, how to properly utilize credit, and how to develop long-term wealth. Those are our main goals with that. And I'm also a first-time home buyer and veteran educator. So if you ever are interested in watching A to Z video on literally the step-by-step process of buying your first home, we have that available for you as well. So let's go into some credit score requirements. These are one of the biggest things on every type of loan. But for FHA loan, let's just go down to how reasonable FHA loans actually are when it comes to credit score requirements. So you can actually go down to a 500 credit score if you're putting 10% down or more. So FHA will actually allow you to go down to a 500 credit score if you're putting at least 10% down. 580 and higher if you're putting the minimum down payment of 3.5% down. And again, the 500 minimum credit scores, it's going to be the least accepted. It's going to require more paperwork and a little bit of elbow grease in there. So be prepared that you are going to have to jump through some extra hoops if you do have that lower credit score and you're going that route. It is possible. I've done dozens and dozens and dozens of them, but it does take a certain mentality. So it's something you want to prepare for, that you are going to have to jump through some extra hoops and get some extra paperwork. A 640 or higher credit score is typically going to be the most accepted, and it's going to be the less stringent type of underwriting criteria that there is. And even if you have a 680 or higher, you're actually going to want to compare apples to apples. Compare an FHA mortgage against a conventional loan, maybe only putting 3% down or 5% down. And the only reason that you typically might do an FHA loan in that case is because you have a higher debt to income ratio. Conventional loans are very, very strict on their debt to income ratio requirements in regards to that. So that's something to think of in terms of that as well. And it's also the most lenient type of underwriting requirements. So if you've got between a 620 and a 680 FICO, again, you're going to want to compare between conventional and FHA. So credit score and lender overlays. So again, while a lot of lenders are going to offer FHA loans, some lenders are going to have what's called overlays. And that's basically just a rule stacked upon a rule, stacked upon a rule. For example, it's very important to me that I work at a place where we have different options to where I can actually say, okay, this particular lender that we use will not entertain this credit score. However, B lender does. So we have that ability to do that. And also some lenders might have a tighter debt to income ratio requirements. For example, even though FHA will allow you to go a high 56% debt to income ratio, some lenders might be like, you know what? We just don't like the risk of it. We don't want to do anything above 50% or 52%, something of that nature. And then some lenders, they might also have minimum FICO score requirements. Some lenders out there say, hey, we know FHA will go down to a 580 with 3.5%. We're only going to do 620. So that's something important to think about as well. So if you are with a lender and you have, a 615 credit score, and they tell you that you're not eligible because of your credit score for an FHA loan, that's simply because they have an overlay. So that's something that's very important to think of with that. And again, even though FHA allows down to a 500 credit score, 500 FICO score, different lenders are going to have different rules, and that's what lender overlays are. So again, what's an FHA loan? It's just the Federal Housing Administration, FHA, and those are mortgage loans that are insured by FHA. It's a government agency. And again, I always like to explain FHA loans to my clients as it's kind of like a Band-Aid loan. It's a bridge loan. It's not something we want to be in for more than a few years. If we've had some credit hiccups or things like that, it's a great bridge loan designed to help get you into the home while we're getting our credit score up and doing some things like that. And it allows us to eventually move forward and refinance out of that. So again, the benefits, lower down payment, only 3.5% down, and it makes homeownership a lot more accessible. And it helps ease the burden of saving for a larger down payment that's typically required by more stringent conventional loans guidelines. And again, we have easier credit requirements. They're more forgiving of credit scores and credit hiccups that we've had in the past couple of years. And it's going to allow individuals with lower credit scores to qualify for financing. So let's go over FHA loan closing costs here. So closing costs are going to include the following: any type of third-party fees. So this is your appraisal any type of home inspections or a pest inspection that you might be getting, and credit report fees. Those are all part of your closing costs, and those are third-party fees. And then title insurance and other title and escrow fees, transfer tax, lender fees, any underwriting or processing fees that are associated with that are part of FHA loan closing costs as well. Every single loan has closing costs with that. And then also your prepaids. These are your taxes and insurances for impound accounts. So what that means is every single month with an FHA loan, when you're making your payments on that loan, you're also having your taxes and insurance paid. This helps protect you by not having to write a big fat check maybe once every 3 months or so. However, that county collects taxes, having to write a big check with that. They're just going to simply be taken out every single month. But how they do that is they collect those upfront and they have them in an escrow account for you to be able to pay those. Upfront mortgage insurance. FHA loans require an upfront mortgage insurance premium, typically, which is 1.75% of the base loan amount. So that's a one-time fee. You don't have to pay that in cash if you don't want to. Matter of fact, it's extremely rare that someone does that. It simply gets added on to the top of your loan amount. So let's take a look here. Let's say our loan amount's $400,000 and our FHA upfront mortgage insurance is 1.75%. That's going to make our total loan amount of $407,000. So that's how the upfront mortgage insurance works in that scenario. And guys, I apologize. We meant to have a sample loan estimate in here, but for some reason that did not go in there. So I'm just going to put a link to another video that will show you what exactly a sample loan estimate is and how we go through that step by step. So let's understand real quick where rates come from. And this is something that a lot of people get confused, and the media, and I think overall the mortgage industry does a horrible job explaining how this works. So here's one of the best, graphics and designs that I ever saw that really help explain where mortgage interest rates come from and how they work. So a pool of investors get together, and this could be people that do 401ks, all different types of people. And they're a pool of investors, and they're investing in what's called mortgage-backed securities. And guys, this is strictly for an example. This is not what actual, interest rates are. Everybody's going to be different. It also depends on the time of the market, what's going on with interest rates. So this is purely an example. But let's say they buy that bond, those mortgage-backed securities, and they buy it at 5.5% interest rate. They then take that and they send it to Fannie Mae, Freddie Mac, and Ginnie Mae. Fannie Mae, Freddie Mac, and Ginnie Mae are the three biggest securitizers of mortgage programs. So since we're talking FHA today, we will focus on Ginnie Mae. So Ginnie Mae is responsible for the government loans, so FHA loans and VA veterans loans. So then they need their little cut. So they're going to add 0.25% fee to that for their servicing and securitizing of those loans. They then are going to say, okay, all these different banks we have, all these different lenders, here's what we're selling this yield to you for at the current market. Well, the banks and everybody else, the lenders, have to make a little bit of their money on it as well. So then they're adding their fee in there of 0.25%. And then this eventually is what we get our mortgage interest rates are that go to the borrowers when you're borrowing money. So that's how it works. So if you ever hear something saying, oh, this bank is doing this loan for free or this is happening, that does not happen because you have so many investors involved in there. So this is just a nice picturesque sample of how mortgage interest rates work and where they come from. So let's talk down payment on FHA loans. So if you have a 580 or better FICO score, the minimum down is 3.5%. That's 3.5% of the purchase price. If you have a 500 to a 579 FICO credit score, the minimum down is going to be 10%. And yes, you can put down more than the minimum if you like. So if you've got a 600 credit score and you've got 7%, 8% that you want to put down, you're more than welcome to do that. You don't have to just put what the required minimum down is. If you have more to put down, you're more than welcome to do that. So where are some acceptable sources of this down payment that can come from? So you can have your own funds. Now they must be seasoned. We're going to talk about more of this coming up because this is usually one of the biggest hiccups that people have during the home buying process. And if we do some things early enough, that can be prevented and a lot less of a headache. So we're going to go over that. Gift funds. These could be gift funds from family. With that, for example, your mom and dad want to help you purchase your first house. They can give you gift funds for that. You can sell an asset. So if you have a car or something of that nature that you own free and clear, you can sell that. This is very important that we have to be able to paper trail those funds. They've got to match exactly, and we need to be a bill of sale from the sale of that asset. And then there's various down payment assistance programs out there as well that we can take a look at. So let's explore some down payment assistance programs. So personally, these are used as a final and last resort. I don't think these are the best option for someone if they have those other means available. And they're going to vary by different states. Every state has them. And they're typically going to be higher interest rates than standard FHA loans. And they're typically going to have some income restrictions that apply, and then some other stipulations on home sale and equity splits. So for example, if you use a down payment assistance program, it's not uncommon that if you sell that house or leave that house within 3 to 5 years, you have to split a percentage of that equity with the state that gave you assistance program. That's one of my biggest pet peeves whenever I hear down payment assistance is, oh, free money. It is not free money. I will tell you right now, when it comes to home buying and financing, nothing is free, and the state's not going to give free money. There's always stipulations with that. And they typically have a lot more stringent debt to income ratio requirements. Remember earlier when I said FHA allows you to go up to a 56% debt to income ratio, a lot of the down payment assistance programs won't allow you to go above 50%. And then typically they will have a minimum credit score of 640. So if you remember earlier, these are examples of what are called overlays. And there's typically more overlays that come with down payment assistance programs. So let's look at seller credit. So seller credits are fantastic, and it kind of depends on the market you're in. Right now, the market that we're in, we are seeing seller concessions being accepted a lot more. So FHA loans permit fantastic seller credits up to 6% of the home's purchase price. So if it's a $400,000 purchase price, FHA will allow up to $24,000 to be used as a concession from the sellers to help pay closing costs. They can be used to help pay down the interest rate. Very versatile use. Right now, what we're doing is a lot of help in buying down the interest rates, for our clients that are utilizing FHA loans. Remember, it's an exclusion for the down payment. So you can't use any of those seller concessions that go towards any of the required 3.5% down payment. They can be totally used for all of your closing costs. If there is money left over, we can use that to help buy down the interest rate. And then consideration of offer attractiveness. While seller concessions, they can be beneficial and they are good for the buyers, a lot of times it's important to understand that they could impact the attractiveness of your offer. So especially if you're competing with multiple other offers, it's very important that you have a good game plan developed and you have a very good lender and a very good realtor team that can go to the selling side and really know how to present your offer in a strong united front with that. So here's a seller's concession example. So our purchase price is $400,000. So our required down payment of 3.5% is going to be $14,000. And in this scenario, our estimated closing costs and escrows are about $8,000. And the sellers are giving us a 2% seller concession. So they're basically paying all of our closing costs. So they're taking care of all of our closing costs. So in this particular example, the borrower is only having to come in with their required 3.5% down payment. So again, make sure you have a good realtor that can negotiate this properly and really understands it. So credit scores explained. So literally a couple of times a week, I will get the argument of, Aaron, my Credit Karma says this. That's great. We don't use Credit Karma. We are required by law to use a different scoring model that we use. Credit Karma is fantastic. I use it myself. It's a great way to monitor your credit, make sure things are being reported correctly, and keeping tabs on things. You will get alerts. Hey, it looks like your Visa payment was due a week ago and you haven't paid it yet. Make sure you pay it so you're not getting a 30-day late. So Credit Karma, I love it. It has a lot of great uses for that. However, it's not what we use. And because it is a different scoring model factor that we use, it's not uncommon that someone might say they have a 720 on Credit Karma, but we pull a 680. That happens all the time. So just understand that. And no, we cannot use your Credit Karma report. I've even had people try and say, well, I want you to use this one. It's better. We can't do that. So the lender's going to pull what's called a tri-merge credit report, and it's typically going to have 3 scores on it. It's going to have a score from Experian, TransUnion, and Equifax. Those are the 3 big credit bureaus that do reporting. And the middle FICO score is what's going to be used for qualifying. If you have 2 borrowers on the loan application, say a husband and wife, the lower of the 2 middle FICO scores is used. So if the husband has a 687 FICO score, but the wife has a 650 middle FICO score, we're required by law to use the 650 credit score for qualifying. So that's something to keep in mind with that. And if you have no tri-merge credit report, so if we only have 2 scores, we're required to use the lower of the 2 scores. And now FHA does allow, believe it or not, no credit scores at all. I've seen them all the time. It just could be someone hasn't developed enough credit yet, or they just haven't utilized their credit in a long time. So we can actually do an FHA loan where there's no credit scores on it. And that's called a manual underwrite. And we're going to get more into that as well too. So credit events and histories. So again, FHA loans are a lot more forgiving of 30-day lates that may have happened in the past 12 to 24 months, both on revolving accounts, which are credit cards, and also installment loans, which is a car loan. So an installment loan is something that has a definite end date. A credit card is a revolving account because it can go on forever. You can pay the balance off, then you can put a charge back on there, etc. Now, FHA does have a caveat that's something to pay important to. If you have a non-medical collection that is greater than $2,000, it either one requires a payment plan or it's going to have to be paid off, or we're required to use 5% of the balance, which must be calculated into your debt to income ratio. So let's take a look at that, an example. So let's say there's a $4,000 collection and we have to use 5% of that balance that's showing on the credit report. So that's a $200 per month payment that we have to calculate in to our overall debt to income ratios for qualifying. And conventional loans are a lot more difficult to get approved with recent late payments in the past 12 to 24 months. So credit events and histories. So this is something unique that just happened with President Biden. He did what's called a Caver's wipe and federal debt. So for federal loans only, which are student loans, etc., if it was in default, it was more than likely taken out of default. And what a Caver's report is, real quick, is every single government loan, so that includes FHA loans, gets run through what's called a Caver system. And what that's looking at is there any federal debt out there that might not necessarily be reporting on the credit report? And is it in default or is it behind, et cetera? Because since FHA is a government insured loan, FHA doesn't want you having any other government insured loans that are in default. So you cannot have any defaults on any other federal loan that are not reporting. Now, this is important to note. If you're having lates, it's still going to impact your credit score, and it could cause a lower score that can impact your approval. But Biden basically did a Caver's wipe on that where it eliminated that. And again, FHA does not care about medical collections. More than likely, we're required to do what's called a letter of explanation, where it's just a feel good thing for the underwriter to feel good about on why they made the decision of approving your loan. So if you do have some medical collections in there, we just have to tell a story about what happened. Hey, I, got in a car wreck and broke both my arms. And I thought the insurance had paid for that little $3.57 paperclip fee that the hospital charged me. And they didn't. I got sent to collections. I didn't know about it. Paid it as quickly as I could. Something of that nature is what we have to explain with those. So credit events and timelines. So this is something very important to ask, because a lot of times I will talk to people and they're like, oh, I had a foreclosure. How long ago? Like 8 years ago. What? And they never think they can get a house again. Well, that's just not true. So credit events and timelines. So if you've had a deed in lieu of foreclosure, a short sale, or a foreclosure, the time frame is 3 years from the transfer date. Okay. So that means you filed for a foreclosure, or you had a short sale, and the date that is stamped and signed from when that actually transferred back to the bank, 3 years from that date, if you had a foreclosure or short sale, you are eligible to buy a house again, and you can utilize FHA financing for it. If you've had a Chapter 7 bankruptcy, it's 2 years from the discharge date. So a Chapter 7 bankruptcy is when they completely wipe out all your debt. Hey, you're starting brand new. So the date that shows up on your credit report of that actual discharge date, you are eligible to receive FHA financing 2 years after that date. And then a Chapter 13 bankruptcy is when they basically negotiate your debts with the creditors. And it could be, hey, we're going to cut your balance in half. We're going to lower your payments by 50%, something of that nature. And as long as you've had 12 on-time payments and the court approves it, you are eligible for an FHA loan just 12 months after a Chapter 13 bankruptcy. So that is important to note. It's going to be an automatic manual underwriting in when that happens. And if you've had any type of IRD lien, that was supposed to say IRS lien. If you've had any type of IRS lien, you must have three on-time payments, and that payment must be included in the overall debt to income ratios. So FHA mortgage insurance requirements. Again, FHA loans have mandatory mortgage insurance. It has 2 mortgage insurance premium. It's got that one time that we talked about earlier. That is 1.75% of the base loan amount. And then it's got a monthly mortgage insurance premium of 0.55% of the base loan amount. And again, that's on there forever. And that's why we would just want to use FHA loans as a bridge loan or a Band-Aid loan to help you get in the house. So let's look at an example. Here's a $400,000 loan at a 6.75% interest rate. And again, these interest rates are just for educational purposes. This is not your interest rate. This is just purely an example. So let's take a look at how this happens. So our total monthly payment in this scenario on a $400,000 loan amount is $31.1066. Principal and interest, or P&I, is $25.94. Our estimated homeowners insurance premium is $83.33. And our estimated taxes on the property are $250 per month. And then our mortgage insurance is going to be $183.33. So you can see right there, our mortgage insurance is almost $200. So you can see why, when you're in that position to refinance out of a FHA loan into a conventional mortgage product, it's going to make a lot more sense for you. Now let's talk about FHA property requirements and conditions of the property. So first and foremost, FHA loans are for primary residence. I can't tell you how many times we've had people try and say they're using an FHA loan and they're going to live in that property when they just plan on renting it out. That's called mortgage fraud or occupancy fraud. It is legal and they will eventually catch up to you. I promise you. Now, that does not mean you cannot eventually rent that house out and still have an FHA loan on it. You just have to occupy and live in that house for at least 12 months. So for example, you buy a house using an FHA loan and you've been living there for a year, a little over a year, and you decide you want to go and buy another house, you can still have that FHA loan on that house and now rent it out. You just have to use it for the initial investment of living in the house as your primary residence. That's something very important to keep in mind. You have to occupy the house within 60 days of closing. Only 1 to 4 units are allowed for FHA loans. So a single family residence, a duplex, a triplex, or a fourplex are all allowed. And again, it's very important to work with the right agent and lender who understands this. And you also want to make sure it's an FHA eligible property. And you want to make sure you're familiar with the process and property requirements and that your real estate agent can negotiate properly. And again, you must live in the home for 1 year before being able to rent it out. And how long before you can sell the home? There is not a time frame. So if you buy the house and all of a sudden it's 6 or 7 months later and you get a job offer to move across the country and you have to sell this house, you are more than welcome to do that. And please note, again, occupancy fraud is considered mortgage fraud and you can and will be prosecuted if they catch you. So again, types of properties allowed: 1 to 4 unit properties, townhomes. Manufactured homes are allowed. It must have been built June 15th, 1976 or newer, and it must be on a permanent foundation and classified as real properties. And it must have a floor space of at least 400 feet or more. And condos are allowed, but they must be approved by FHA. And we'll go into more of that again later with that. And property condition requirements. Again, FHA loans have minimum property requirements. The property must be safe, sound, and sanitary. Guys, the easiest way I just explain this is something going to cut you? Is it going to burn you? Is it going to shock you? Are you going to fall down the stairs because there's not a safety rail? It's general, normal stuff that you would want to have in any type of house for safety requirements. The property's got to be considered move-in ready. The property requirements are a little bit more stricter as opposed to conventional loans because FHA loans are insured by the federal government and they want to make sure that you and your family are safe in that house. And the appraisal will stick with the property for 4 months. So what that means is if you're doing an FHA loan and the house gets appraised, and let's say it appraises for under the sales price, and the sellers just don't want to budge, well, the next month, if another FHA offer comes in, but it was higher than yours, they're stuck with that FHA appraisal. So that FHA appraisal stays with the property for 4 months. And let's look at some examples of things that would be required to be fixed on the property. So if you have any open wiring, again, something that's going to shock you, safety handrails on decks or stairs, safety strap on the water heater, and chipped paint are some of the most common things that we see called out. So we want to be able to educate the seller and the agent that represents them, like, hey, if any of these things are there right now, have those things fixed or ready to go before the appraiser comes out there. It will make life a lot easier on everybody. And again, some property condition requirements. These are all easy fixes and should be completed before the appraiser goes to the property. Again, it's going to save everybody time and money. And here's some appraisal highlights to be aware of. The adminitory clause protection. What that is, the adminitory clause is basically just stating that everybody's aware that this is an FHA loan and that if the house doesn't meet these standards or we can't agree to get it brought up to FHA standards, then the buyer's allowed to back out with no penalty. They're allowed to get their earnest money back and all of that as well. The roof must have at least 2 years of remaining life on it. No exposed electrical wiring. All appliances must be operational. And handrails are only needed if determined that it poses a safety threat. So it's typically, higher than a few steps. No standing water on the site near the foundation. So we've actually had situations where it's rained and the appraisers went out there and they literally have to wait a couple of days for the water to evaporate. That's all it is. Things like that happened. The attic must be accessible. So the appraiser needs to be able to get up to the attic. And a pest inspection is only required if there's evidence of infestation or past infestation. So the FHA appraiser, if he sees that there might be a problem with pests or termites, he's going to call that out. And then it's at an underwriter's discretion if they want a pest inspection on that property just to make sure. And again, the property line cannot be located within 300 feet of a ground or subsurface of stationary storage with a capacity, water capacity has to have a gallons of 1,000 or more, and typically homes next to gas or radon. If the home was built before 1978, there's no chipped or peeling paint on interior, exterior of home. If it's built after 1978, exterior paint that exposes subsurfaces, it must be repaired. And obviously any broken window needs to be repaired, but cracked glass does not necessarily need to be replaced. So let's talk about lender overlays that we talked about earlier. So some lenders, again, are going to have what is called overlays. So example, Bank A won't do an FHA loan below a 640 or a 620 FICO score. That's a lender overlay. This is because they're lending their money. FHA only insures the loans. So I've had arguments that I've heard all the time. Well, FHA says they'll do this. Okay, but it's still not FHA that's lending their money. The bank is fronting their money on that. And some lenders may also have tighter debt to income ratio requirements like we spoke about earlier. And some lenders may not do manual underwrites. They're like, nope, this is what we like to do. Somebody else can do those. We do have lenders that will go down and that follow directly to the FHA guidelines. And then not all lenders have the bare minimum to do that. And just because you're eligible for an FHA loan doesn't necessarily mean you'll get approved. So I'll give you a perfect example. Someone who's on fixed income, they might be retired. They have a great credit score and everything's fine. However, with what their mortgage payment is going to be and the amount of income that they have that they bring in, their debt to income ratio is 70%. And that just doesn't qualify on an FHA loan. But there is a way around that. And we're going to talk about that a little bit later with co-signers and non-occupant co-borrowers. So where can my down payment come from? Again, we talked about approved down payment assistance programs. The sale of an asset, it must be properly and carefully paper trailed. So example, the sale of a car, motorcycle, etc. A collateralized loan from your 401k, sale of real estate. That's actually a huge and very simple process if it's done correctly and we plan it properly. And they're very liberal with that, especially if you're a first-time home buyer. We can't use any type of unsecured loan. So you can't take money from a credit card or any type of personal loan. And the Patriot Act does require lenders to look at bank statements for evidence of money laundering or possible terrorism. So when your lender is asking you for all these pages of the bank statement, even the last one, and there's weird deposits in there, no one's picking on you. We are required by federal law to make sure that we can paper trail and source where the funds for the down payment came from. Condos. So a condo association must be approved to make sure that the home value is stable. It has to be on the FHA condo list approval. And you can actually Google that and look up different condo associations and see if that condo is approved. Single unit approvals can happen, but are very difficult and they can take a long time. I've tried to do a few in the past and it's literally been several months and we get to the very end and it's like, nope, one little thing was wrong. And I'll talk about what that looks like. So the condo association must have the following for one unit to be approved. So that condo's got to have at least 5 or more units to qualify. If there's less than 2 units, only 2 of them can be FHA. If it's greater or equal to 10 units, 50% can be FHA. And if it's greater than 50% must be owner occupied. All those caveats have to happen. So you can see why that takes some time and why it is harder to get those approved. Also, the association must have 10% of their HOA budget in cash reserves and liquid reserves that are an account that's easily accessible. Greater than 85% of the units must be current on their dues. No more than 35% of the units can be used as commercial use. And they must be recertified every 3 years. So every 3 years, the condo has to do a questionnaire, the condo association has to do a questionnaire, resend that off to FHA in order to maintain their FHA approval status. And just to show you guys the success rate on single unit approvals, this was from 2022, I believe. It's about 50%. So there was 15,499 approved and 15,241 were rejected. So HUD reports that about only 6.5% on condos in the US would actually be eligible for FHA financing. Loan limits. So FHA loans do have loan limits that are set by the county and the state. There are normal loan limits, and then there's also what's called high cost areas. And then loan limit size is also dependent on the number of units. So again, if it's 2 to 4 units, and there's more units, they allow for a larger loan amount. And you can actually look up the loan limits lookup tool here in there and put what county you're in, what state in your county you're in, and it'll tell you exactly what the loan limit is for that county. So income qualifications. So they want to see a good 2-year stable employment history. This does not necessarily mean you have to be on the same job for 2 years. I have a friend who is a contract plumber, and the guy gets like 7 or 8 W-2s a year. He gets several jobs. They just want to see that you've had continual and stable employment for the last 2 years. And again, there's no set length at a specific job. It is ideal to be in the same line of work if changing jobs. That's just easier to connect the dots and tell the story. And if you're in retirement, and schooling counts. So for example, someone who's in nursing school and just started their job at the hospital, but they've only been there for 8 months. Well, we actually get to use their specialized schooling as part of their employment history because they were training for that particular career. We can use non-taxable income to gross up 115%. So examples, Social Security, disability can all be grossed up. So if someone's receiving $2,000 per month in Social Security, we can actually gross that up 115% and use $2,300. So that can actually help in the difference between someone being qualified and approving for a home loan and not being approved. And if you've had a 6-month or greater gap in employment, you need to be back on the job for 6 months minimum. So if you haven't been working for 8 months and all of a sudden you went back to work, but you've only been back to work for 4 months, we need another 2 months. You need to be back on that job for 6 months. But if you've only had a 2-month gap, that's fine. We just have to be able to explain the gap and why it was that you had that gap in there. Affordability, debt to income ratio requirements, gross income, and then pre-tax income. So the front end or the housing payment in your debt to income ratio. So this is the percentage of your gross monthly income that is going purely towards your house payment, your principal, your interest, your taxes, and your insurance. And then your total back end, FHA will allow you to go all the way to 56.99%. So that's your housing payment plus any normal revolving costs that show up on your credit report on a monthly basis. So credit cards, car payments, things of that nature. Manual underwriting requirements will be much stricter and do have lower levels of debt to income ratios. And then if you're in a community property state, so a community property state with government loans, if you are legally married, but only one spouse is on the loan, FHA requires us to pull a credit report of the non-purchasing spouse. Doesn't matter what their credit is. All they're looking for is there any sole and separate debt that's just in that non-purchasing spouse's name. So for example, the husband's doing the loan, but his wife's not on the loan. We have to pull her credit report and she has a $300 car payment. We have to count that $300 car payment into the overall debt to income ratio. And this shows you examples of some of the community property states. So if you're in Arizona, California, Idaho, Louisiana, Nevada, which is where I'm at, New Mexico, Texas, Washington, or Wisconsin, all require the non-purchasing spouse's credit to be pulled. Regardless, there's no arguing, there's no way around it. And please not all will get approved at these upper levels. Typically higher FICO scores and reserves in the bank are needed. So if someone's got, like a 607 credit score and not a lot of money in the bank, it's going to be difficult to get an approved eligible near that higher debt to income ratio. Underwriting. So we have two different forms of underwriting. We have what's called AUS, which is automated underwriting system. And what that does is it looks at assets, income, job stability, credit score, what type of property is, etc. And these underwriting engines are used. They're called Desktop Underwriter, DU for short, or Loan Prospector, LP as well. And what we're looking for is an approved, eligible, or an accept. And what that does is it just has whatever algorithm it uses, it looks at all those different factors and it spits us out an approval. And then that data is verified by a human being. So even though we get that automated approval, we still have to prove it with documentation. Manual underwriting. Not all lenders will do it. I actually started my career by doing a lot of VA and FHA manual underwrites. And it's just, you're just basically telling the story of why you should be approved. And a lot of times it could be because of a recent credit event that happened. That's not giving us that automated approval. And it can sometimes come with a higher rate due to the risk associated with that. Investors are looking, hey, this didn't get an approved eligible, it's a manual underwrite, so it's a little bit more riskier. Manual underwrite is going to be for loans that don't have a credit score or that receive a refer from the automated underwriting engine. This is very, very important. I've seen this actually kill deals and prevent people from being in their house. And we've had loans come over to us that we're trying to rescue, and it's something that should have been caught day one. We catch it in a matter of minutes when we're doing it. So you can't have any lates on housing or installment loans in the past 12 months. So if you paid your rent late once, you had one 30-day late on your rent payment, it's going to automatically decline your loan. And they do require us to get what's called a verification of rent filled out from the landlord or whoever the association is that's doing it. And you can only have two 30-day lates in the past 24 months on any other types of debt, so credit card or something like that, or installment loans on cars or rents. So if you had a late rent payment 15 months ago, that's fine, but nothing in the past 12 months. And then revolving debts, credit card, you can have two 30-day lates in the last 12 months, and then 0 by 90-day lates for FHA. They don't want to see you go any further than 30-day lates. So that's something very important to keep in mind on manual underwrites. So manual underwriting, this is something very important with FHA. So your credit score, your debt to income ratio is capped at 31/43. If you've got a 500 to a 579 credit score, again, it's capped at 31/43. If you're above those minimum thresholds, max DTI is 31/43 without any compensating factors. And you can actually go higher if you have a compensating factor on a manual underwrite. What's a compensating factor? That's something that we're not necessarily using for qualification purposes, but it adds strength to the file. So an easy example is someone gets overtime, but they've only been getting it for a year and a half. And we have to be receiving 2 years of overtime in order to use it for qualifying. But they've been getting it consistently for a year and a half. That's a compensating factor. It adds extra strength to the file. They're going to be getting a roommate that's going to be helping pay the mortgage. Something like that is a compensating factor. And if we have a 580 and above, the max DTI, we can go to 40 and 50. So 40% front end ratio, 50% back end ratio if we've got at least two compensating factors. So we have extra income that we're not being used. The new mortgage payment could be equal to or less than what someone's been paying in rent. That's another example of a compensating factor with that. And again, here's a few different examples of compensating factors. They've got a few months of reserves for 1 and 2 unit properties, 6 months or more reserves. There's very little payment shock. Again, the housing payment has not increased by more than 5%. And they've been on their job for a long time. We've got some good residual income or extra income that's not being used to qualify. And again, that could be used child support, alimony, overtime, bonus income, etc. Co-signers and co-borrowers are allowed with that. So, co-signers and co-borrowers are allowed. So if you are so the big difference is a co-signer is not on title, and a non-occupying co-borrower is someone that's going to be on title. So for example, I'm going to help my son buy his first house. FHA is nice, and they're not going to make me live in the house with him. He wouldn't like that very much. But we're allowed to use my income to help him qualify for that mortgage. And this right here just kind of goes through the difference between co-signers and co-borrowers and the difference between them and what's allowed. How FHA looks at student loans. So there is a current pause on student loans that's set to literally restart just a month from now in September of 2023. With that, they do allow income-driven repayment plans. And they're also one of the big themes that I've seen, again, that's had issues with many deals, is if that payment on the credit report is showing as 0 or is deferred, FHA requires us to take the student loan payment and calculate it by 0.5% of whatever the balance is that was reporting on that credit report. So here's an example. If they have a $10,000 balance, but it shows that payment is currently 0, we have to multiply that balance by 0.5%, and that would equal a $50 per month payment. We have to include that into the debt to income ratios. You can call your servicer and have them take you out of the deferment and put you into an income-driven repayment plan. That's not refinancing your loans. That's just them taking your income and figuring out what a reasonable payment for you is. And then we're actually allowed to use that as your qualifying payment for you. So special requirements in FHA loan. FHA allowance for DACA. This is for non-U.S. citizens. House hacking. This is something I wish I would have known years ago. And it's something I actually preach very much to my first-time home buyers now. So FHA allows an FHA buyer to purchase a multifamily property up to 4 units and occupy one of those residences. So you can actually live in one of the units, rent out the other units if it's a duplex, a triplex, or fourplex. And what's neat is FHA will actually look at what the proposed rents are, use 75% of those. And as long as those proposed rents meet or exceed what your mortgage payment's going to be, FHA will approve the loan. There's HUD down, HUD REO property. These are really hard to find, and you must use the HUD website for them. 203K rehab loans, that is for properties that don't meet particular FHA requirements. And it's such an in-depth thing. I'm actually going to make a separate video on that so I can go more in-depth to them. It's hard to cover it with our time allotted here for that. And then again, FHA allows for down payment assistance loans. And then one-time closed construction loans as well. Those are, again, hard to find, and a lot of lenders do not do those. FHA refinances. FHA streamlines can be used 6 months or after and streamlined into a lower rate if the market allows it. No income credit or appraisal is required. You must be in a current FHA loan, and it must have a net tangible benefit to the borrower. So you have to have a higher interest rate, it's decreasing your payment, et cetera. You can't just have a lender refinance you just to refinance you. That's designed to protect you. FHA to conventional, it's used to remove mortgage insurance. So like I mentioned earlier, FHA is a nice bridge or a Band-Aid loan. It's not something we want to keep you in forever. So if your credit's significantly improved, or we've had a really good increase in equity in your home, that's something we want to look at and compare apples to apples. Hey, you were paying this. We can put you in a conventional loan. Now you're paying this. It's considerably less. That makes sense. And you can also include the closing costs into the loan amounts. You don't necessarily have to come to the table with any closing cost when you're doing these refinances. FHA cash out loans. Maximum of 80% of the appraised value can be taken out for cash out. So what a cash out loan is you're taking money from your equity. It can be used to, fix up the kitchen or do repairs around the house, or if you want to consolidate debt. Those are all examples of what a cash out FHA loan is. The types of FHA loans really quick. So FHA-B is your standard normal FHA loan. That's the majority of what we discussed here. Then you have your FHA-C loans. Those are FHA loans that are FHA approved condos. And then you have your FHA rehab loans, again, the FHA-K with that as well. Again, FHA rehab loans, the FHA 203K standard, that's designed for repairs on homes that require repairs that will exceed $35,000. So the house needs a lot of work. It must have a minimum of $5,000 in repairs. It can be used for structural repairs. There's the 203K limited, which is just for smaller things. And that has up to a maximum of $35,000 in repairs required. And then again, there's no minimum in the cost for repairs. FHA loans as a tool for the home. So again, FHA loans are a great tool. It's an option to help get you into a home, start home ownership. It is not a forever loan. As a matter of fact, the average life of any type of loan is around 7 years. And the reason is because the economy changes, rates change. If you have a 6% interest rate on a loan and all of a sudden interest rates are at 4.5%, there's no reason why you would want to keep that 6% interest rate. So again, it's a good tool to get you into the house. We're going to continue to work on your credit, your debt to income ratio, and put yourself in a position to get out of the FHA loan in 2 to 5 years. Personally, I don't like to see any of my clients in an FHA loan longer than for about 4 to 5 years. There's no reason. There's plenty of time. The average equity, a nice healthy growth rate is between 4 and 6%. You gain plenty of equity in your house during that time, that you have enough equity that you should not be having mortgage insurance anymore. And then you want to refinance into a conventional loan as soon as it makes sense. So how do you apply for your FHA loan? You find a good lender who does FHA loans and understands them. You can schedule time with me. I'm happy to answer any questions. But one of the reasons why I like to do these in-depth videos is because I found over the years, we get a lot of the same questions. And I said, you know what? Why not make a video where we can put it out there and lots of people can get this information? You want to apply property and you want to submit all your documents, your assets, your income, and have a full credit report pulled. Again, not Credit Karma, get an actual full credit report pulled. Save all your documents. I always tell all my clients, create a little folder on your desktop and name it, house buying stuff or house buying documents. Anytime you get an updated bank statement or an updated pay stub, or it's the end of the year and you get your W-2s, your tax returns, throw them in there. That way you've got everything organized and ready to go. Have your documents and credit reviewed with your loan officer and ask questions. Don't be afraid to ask, hey, what's my debt to income ratio? Anything look weird on my credit report? Believe it or not, almost 7 out of 10 credit reports have faults or old information that shouldn't be on there anymore, duplicate information, etc. Do not rush the pre-approval process. I can't tell you how many times people try and treat the pre-approval process like they're going through a fast food drive-through with that. Whoops, I hope the last part out. Do not rush the pre-approval process and be prepared. I can't tell you how many times people try and rush the pre-approval process, or real estate agents try and rush it. You should be getting your finances in order first. If you know you need to borrow money and get a home loan to buy a home, like the majority of us, you want to be prepared and do that part first, okay? So do not rush your pre-approval process and be prepared. Have the proper documents necessary. I can't properly pre-approve someone if I'm missing vital information and I don't know the answer to it. And do not look at houses or make an offer on a home without speaking with the seasoned lender first. This is a recipe for disaster and stress. I can't tell you how many times people have gone out and looked at houses. Oh my God, we found this house. My wife loves it. And they qualify for a house that's $100,000 less. So that's something just to keep in mind with that. It'll create a lot of heartache. Getting your FHA offer accepted. Again, make sure you're properly pre-approved, and even go a step farther with what's called a TBD underwrite. This will help reduce a lot of contingencies. So if you can go to a seller and say, hey, I've actually had a underwriter review my file and approve it. We just need a purchase contract, a prelim on the property, and an appraisal, and we can literally close this thing in just a couple, 3 weeks. That's something to think about as well. Depending on the market, seller versus buyer, you want to either eliminate the need for seller concessions or reduce them as much as possible. And make sure you have a lender that is willing to speak and help guide the listing agent, explain your offer has been thoroughly reviewed and that you've been properly approved or pre-approved. One thing that we do is we make a video on every single one of our offers that we send out with the pre-approval. And I actually tell them, hey, I have all of their documents. We've ran them through automated underwriting. They have this, they have that. It's a very strong offer. Please call us if you have any questions. Another good thing that works is up your earnest money to show how serious you are. Your earnest money is your sign of good faith. So the higher your earnest money is, that shows how serious you are about winning that house as well. And guys, that's it for FHA loans today. Stay tuned. I'll be making future videos on various different loan programs where we go from A to Z in depth in them. Again, guys, if you are not a subscriber yet, please like and subscribe. It really helps us out with YouTube. YouTube loves that algorithm. Thank you for watching. Take care.